There's no begging, no selling, no chasing, no persuading. In fact, I've never pitched a deal. You see, part of the secret sauce is separating conversations between sharing what the opportunity looks like and is, and then having a deal for them to fund. Because, Stephen, desperation has a smell to it. If I'm talking about a deal that I need funded and I'm explaining the opportunity, I'm already sounding desperate.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
Hello and welcome back to another episode of the Wealth Clock with Stephen Weinstock podcast. Today we have Jay Conner. He's been involved in real estate since 2003. He went through the 2008-2009 crisis. He pivoted like a lot of real estate investors did. But I'm going to let him talk about his background. Okay, Jay Conner, welcome to the podcast.
Stephen, thank you so much for inviting me to come along and talk about my most favorite subject that I'm so passionate about, and that's private money for funding real estate deals. Why am I so excited about it? I'll tell you why. Because ever since February of 2009, when I started using private money, I've never missed out on a deal for not having the funding ready to go and close fast.
Okay, so we're going to talk about private money. I've been in the business since 2001. I've bought a lot of properties with seller financing. We have structured deals, lots of creative ways, from master leases to lease options, depending on where you're from. Money held in escrow for years, sometimes just to make a deal go through. Talk to me about private money. What does it mean? Does that mean you're going to your local watering hole and asking friends for money? Talk to me about what private money means.
Yeah, so first of all, and I'm glad you asked, Stephen, so we can be perfectly clear, a private money transaction is a simple transaction between an individual, a human being, that's the private lender, and the real estate investor that is borrowing the money. There's no middle person. We're not talking about any kind of institutional money here. So the question is where are these private lenders? Well, there's three categories or places where these private lenders are. The first category is what I call the warm market. These are your connections. These are your network of people. They're already in your cell phone. This could be your social circle. This could be coworkers. Could be your professional circle, your attorney, your CPA. Those are gatekeepers of a lot of people that have investment capital and or retirement funds. And so it's your own connections. The second category of private lenders is what I call your expanded warm market. So if you're going to scale your business, sooner or later, you're going to run out of your own connections, for them being your private lenders. So how do you grow your network very, very quickly? Well, at my private money conference, I do a deep dive for about an hour and a half session on how to grow your network. But I can tell you one resource that you can grow your network overnight, and that's Business Networking International, BNI. I started getting involved in BNI years ago, and I have gotten millions of dollars by just being involved in the local BNI, Business Networking International chapter, for growing your network very, very quickly. The third category of where you find private lenders are what I call existing private lenders. These are individuals that are already loaning money out to real estate investors. Where do you find those people? Well, one place you find them is at self-directed IRA networking events. 70% of people that have an account at a self-directed IRA company want to loan money out to real estate investors. Now, when we come back to that first category, the warm market, so, how do you raise money from your warm market? Well, here's what's really interesting, Stephen. I've had 47 individuals fund my deals over the years, millions of dollars. And here's what's really interesting. Stephen, not one of those 47 private lenders that came through my own connection, going to church with them, etc., none of them ever heard of private money, private lending, and none of them had ever heard of self-directed IRAs until I did what? Until I put on my teacher cap, which says private money teacher. So what do? I just led with education, educating people on what this opportunity is that I have of private money, how they can earn high rates of return safely and securely. I did it with one-on-one conversations. I did it with private lender luncheons. So my very first private lender luncheon, I invited about 20 people there of my own connections. And I had my real estate attorney there. I had my CPA. I had my realtor there. I fed them lunch. I did a little 30-minute presentation on what the opportunity looks like. And I got $969,000 pledged from that very first private lender luncheon by simply educating people on the opportunity. So there's no begging, no selling, no chasing, no persuading. In fact, I've never pitched a deal. You see, part of the secret sauce is separating conversations between sharing what the opportunity looks like and is, and then having a deal for them to fund. Because, Stephen, desperation has a smell to it. If I'm talking about a deal that I need funded and I'm explaining the opportunity, I'm already sounding desperate. So it's so important to share the opportunity of what this private money lending opportunity looks like. And then you come back for the deal to get funded. I've got a script that I call the good news phone call, and I get my deals funded 100% of the time because my private lender is already waiting for the phone call for me to put their money to work and get it invested.
Okay, so there's a lot to unpack over there. So I'm going to talk about different parts of what you just said. First, you mentioned that you have one of your methods is you'll invite people to lunch or a dinner, you'll feed them, and there'll be a captive audience for your 30-minute presentation. You are focusing on, I guess, past deals that you've done, not necessarily a new deal that you're seeking because, again, desperation. One thing I really liked is that you're inviting your lawyer, accountant, realtor, as many professionals that help your wheelhouse continue turning. You're bringing them here. So one, even if they don't say a word, gives you gravitas. They have these guys on your side, and it allows these people to talk to each other and give more credibility and really talk about it. When you say private money and you're saying lenders and you're saying private lenders and not institutional, the actual legal structure, and I'm going to guess over here, and I think I'll guess right, but maybe I'm wrong. You're still setting it up legally, structurally as a first lien position. So instead of the lien being, ABC institution or Wells Fargo Bank or, Deutsche Bank for maybe larger deals, it's saying potentially John Smith LLC as the first lien. Sometimes it might be wrapped up in, a combined LLC, et cetera. But ultimately, they still have the first lien position. Am I correct?
That's correct. So the private lender is not a joint venture partner. So, the old business model is somebody puts up the money, somebody else on the partnership does the work, negotiates the deal, then they share in the profits. This world of private money doesn't work like that. Think of the private lender as the bank. So, you as the borrower, it's your entity, your LLC, whatever entity you're operating in is the borrower. And then the private lender is going to get the same security and protection as the local bank. So this is what's called asset-backed debt. So we're not going to borrow from the private lender unsecured funds. They're going to get the same protection as the local bank. So they're going to get a promissory note, and then they're going to get a deed of trust or a mortgage, depending on the state the property is located in. And so that deed of trust or mortgage is going to collateralize that note. We're also, just like the local bank, we're going to name the private lender as the mortgagee on the insurance policy. So if there's ever a claim against that insurance policy, then the private lender is named on that check. So the private lender's got to sign off on that insurance check, just like the local bank. We name them on the title policy as an additional insured as well. So they're getting all the same security as a mortgage company or a bank would.
So this gives them the security as a bank. There's more flexibility with private lenders than with institutions, whether it comes to leverage, whether it comes to upfront points, whether it comes to speed of execution. And depending on your relationship with these private lenders, you might be able to get a more superior deal across the finish line because you have the lender's confidence.
Absolutely. There's 20 reasons why I love doing business with private lenders. I'm not going to give all 20, but I'll give you a few of the big ones. Number one is speed to close. So we can close deals much, much quicker because we don't have all the entanglements of institutional money. I make offers to my off market for sale by owners, close in 7 days. Now, if they're living in the property, they can't get out that quickly. So what we do is we'll close within 7 days, give the seller half of their proceeds at closing. They can stay in the property for whatever length of time for free that we both agree upon. Then they get the other half of their proceeds when they vacate the property. But speed to close, you get more offers accepted the quicker that you can close. Secondly, there's no limit to the number of private lenders you can have. There's no limit to the amount of private money you can borrow. You know, with Fannie Mae, somewhere around about 10 deals and you're maxed out. If you're using institutional money with Fannie Mae, well, there is no limit. Another reason is that I love doing business with private lenders is because when I'm buying a house that needs rehab, I'm getting all my rehab money up front. There's no such thing as draws. I always have excess cash to close because I'm able to buy these properties at a discount. I'm always able to borrow more money than I need for the purchase and the rehab because of the equity in the property. So instead of taking money to the closing table when you purchase, you're actually getting a check when you buy. So the question is, who wants to get paid to buy houses, right? And so this world of private money just fixes your cash flow. And, you know, we buy a lot of off-market houses. And like you said, buy with seller financing, buy subject to the existing note, lease options, etc. But in my experience over all these years, only 13 of the for sale by owners that we negotiate with will sell creatively. What do the other 87% require? All the cash, right? And so when you've got private money on the shelf, ready to go, ready to be deployed, then think about how much more confident, how many more offers you're going to make when you know exactly where the money's coming from. Stephen, I don't know if you've ever heard, have you ever heard the guru stand on stage and say, oh, just get the deal under contract, the money shows up? You ever heard that?
Too many times.
Yeah, that's hogwash, as we say here in Eastern North Carolina. I mean, you get a deal under contract, is a drone going to fly over your front door and drop a bag of cash on your front door because money finds good deals? Has money got legs running around looking for deals? No. Common sense, get the money lined up first. I mean, that's pretty downright stressful to get a deal under contract, and you have no idea where the funding is coming from, right? I've heard story after story after story of losing deals because they couldn't get it across the finish line. Get the money lined up first, and then you never have, there's always going to be deals. There's always going to be deals. Get the money lined up first, and then go make offers, make offers, make offers, and close more deals.
And when you have the money lined up first, you can make offers similar to cash offers because they know you have, the speed to close. You're not relying on an institution that might deny you or change the proceed amount as you get closer to the closing table.
Or like I experienced all the way back in January of 2009, I thought I still had a line of credit. For the first 6 years, I was using the bank a line of credit. I had 2 houses under contract, called up my banker, and I learned over the phone my line of credit had been pulled with no notice to me whatsoever. So I knew I had to find a better and quicker way to fund my deals.
Yeah, I was around during that period of time, and things really went from super easy. We're talking about those stated income loans, buying with a first and a second, all simultaneously closing a first position 80, a second position home equity loan, all at closing. Definitely easy days. Once 08, 09 hit, it got really, really tough. For me personally, it got really tough. I was upgrading from, I guess, a personal home, a starter home to a bigger and, more, a better. And this is 2010. And I was putting down 50%.
Woo!
And yeah, and the banks were, and this is in New York. This is, I'm not in some town that they can't appraise. This is in Brooklyn. And the banks were just so gun shy on everything and everybody. And I didn't have a standard W-2. I owned, a bunch of real estate. And I remember it took me probably 6 or 7 months with 50% down to buy a primary home in New York. And I was just thinking back the 5 or 6 or 7 years previous I was able to buy it, just almost with a pulse based on those days, the stated income loans and all that. And it was really tough. It really made buying really hard, especially for investors. Things I think picked up maybe 2011, 2012 with the advent of, I guess they call it DSCR loans. But private money was always great, was always the best. And I really like how you focus on the private money. Let me pivot a little. What kind of properties are you buying, and what are you doing with these properties?
Yeah, so the properties that I've been buying all the way since 2003 are single family houses. And depending on how I buy them determines how I sell them. Now, I've sold a lot of homes on lease purchase or rent to own and help people increase their credit score to where they could cash out. Since COVID back in 2020, the majority of these houses we've done is turn them into brand new homes, renovate them, turn them into, beautiful homes, and then just cash out on them because the profits have been so big. Our average profits have been $86,000 per single family house. So we renovate them, cash them out, and we've also sold a lot of houses on lease purchase as well.
When you say cash out, are you referring to getting a standard permanent loan on it, or are you talking about selling it?
Selling it, putting it in the multiple listing service, and selling the property. Yep.
Got it. So you're not holding on to these long term for the most part.
For the most part, that's correct.
And when it comes to private money, are most of these investors, or are the terms structured usually in a short term? Is it a 3 to 24-month type of deal?
No, all the length of the notes are either 2 years or 5 years. So that gives me the flexibility on the exit strategy. If they're just using investment capital, I'll do the note for 2 years. If I haven't cashed out in 2 years, they don't want their money back anyway. I mean, what are they going to do with their money if I give them their money back, right? So we'll extend those notes. If they're using retirement funds, I'll introduce them to the self-directed IRA company that I recommend. They'll move that money over, and we'll set those notes on 5 years in case I'm doing a long-term strategy. And the reason we'll do the 5 years is because, and most of the time we don't use it for 5 years, but it just gives us that flexibility. And the reason we'll do 5 years on the retirement funds is because they're not, the interest is not going back in their pocket anyway. It's going in their retirement account. So they're not looking for that money to be coming to them personally.
Got it. And typically the payment structure for these loans are interest only, balloon payment at the end?
So they're all interest only. And that's a win for the lender and a win for you, the borrower. It's a win for the lender because they make more money. If you're paying principal and interest, you're paying their principal down. They don't have it all totally invested. And it's a win for you as the borrower because interest only payments are smaller on cash flow than principal and interest. And so the length of the notes, the frequency of payments are either going to be monthly, quarterly, or semi-annual, unless I'm doing a quick flip. If I'm doing a quick flip, then the interest would just accrue, and that would be paid at the time of, paying the principal loan amount off. But, if I'm going to be using the money for, say 9 months, a year, or maybe longer, then I just let the private lender choose what they want to do. Now, if they're using retirement funds, and they've moved their money over to a self-directed IRA company, then I'm either going to pay quarterly or semi-annual. I'm not going to make monthly payments because it's not going in their pocket directly anyway. But if they're using investment capital, I leave that totally up to the private lender because they have different objectives. Some of our private lenders need the monthly income because they're supplementing their income with the interest that's being earned. So in those cases, we'll pay them monthly. But if they're not needing the monthly income, then we'll pay them typically quarterly.
Let's dive into the tax aspect of this. Just to give a little background, I own some property from single family to multifamily, structured all the way from, me being the sole owner all the way to syndicating and raising capital on the LP side, on the limited partner side. Tax benefits for those type of investors who are coming in, joint venture, limited partner, they have a lot of tax benefits, but they obviously have more risk. They don't have a lien on a property. They really just have to really have real confidence in you as the buyer, the borrower, everybody in one. With the lien on the property, obviously, they're confident in you, but they're secure. And depending on the leverage and the loan to value, they're really okay. And, unless it's 110%, for the most part, they should, maybe with some hassle and some legal process, they should be made in full and along with all the late fees and all that. With your investors, these are taxed as income because they're not seeing profits. Their risk is less. They're taxed as regular income.
It depends on what money they're using. So if they're using investment capital, it's just cash in the bank that they're investing, then that is taxed at ordinary tax income. Just like if you put money in the bank, you're going to get a 1099-INT at the end of the year. However, if they are using retirement funds, then that is either tax deferred or tax free. If they're using like a Roth IRA to invest, then that's after tax funds that are in that retirement account. So there is no tax on that. So again, investment capital, ordinary income tax, retirement funds, it's either tax deferred or tax free.
Yeah, I have some investors on the LP and equity side that are using self-directed 401k trusts. And those guys are never bothering me about K1s. They don't care about depreciation. It's just very interesting. And you have the high W2 guys who are, all over it, January 2nd, where's the K1? Where's the K1? And then you have, the real estate guys who are, in tons of deals and, they own their own business and, they're fine with multiple extensions till September before they're paying the tax man.
Exactly. Exactly.
Let me, where are you from? Yeah, you mentioned East North Carolina before.
Yeah, Eastern North Carolina, a very, very small town, Morehead City, North Carolina. And our total target market right here is only 2 counties here in North Carolina. So I like being a big fish in a small pond to where we can sort of dominate the market as far as finding these motivated sellers.
And you're born and raised over there as well?
Yep, this is where I was raised.
Got it. How'd you get into real estate?
Well, I was actually born into the mobile home business, manufactured housing. Back in the 50s and the 60s, they called them trailers and wobbly boxes. But then they, the industry got all sophisticated and grew into manufactured housing. Well, my father was the largest retailer of mobile homes in the nation back in the 80s. Yeah, had 160 sales centers in 10 different states. And so I was raised in the industry of providing affordable housing to families. And unfortunately, in the early 2000s, all the consumer finance for that product went away. Well, if you don't have consumer financing for that product, you're not going to be in business. So I knew if I ever got out of the mobile home business, I wanted to get into single family houses. I started flipping houses in 2003. And that's before HGTV was even, a household name, right?
Yeah, mobile park business is a good business these days. I know a lot of people are buying packages, and it's definitely an interesting asset class. I think the mobile park business lends itself well to lots of creative financing because I guess you have, people who own the home, they own, they're renting the lot, they're buying it, they're buying existing, they're getting foreclosed on and owners are reselling it. So there's lots of private and creative structures when it comes to that. Have you ever bought 2-family, 3-family property, the 1 to 4s, or are you strictly a single family person?
Yep. I've focused just on single family. However, the private money, like I'm talking about, can easily be used for duplexes, triplexes, quadplexes, et cetera.
Interesting. Yeah. Single family is, although on the management side, especially if you're a landlord instead of, a flipper or somebody who is reselling, on the landlord side, could be just very tough as far as scaling the product. The single families to me are, I think, the safest real estate, the safest part of the asset class. I think it's the most liquid. You could sell it to investors and you could sell it to homeowners. There are people who need it even when the rates are high and not just at 2 or 3%. When someone's, 32 and they're expecting their second kid, they got to buy a house and, they can't necessarily wait for the rate to go down. Maybe investors could wait, but I just think these assets are the most liquid. And I remember years ago when everyone was making a big deal about Blackstone buying, millions or billions of them, whatever it was. For them, I think it was a hedge on inflation. It's the perfect asset class. You could sell it off one at a time. You could sell it off as a package, and it's liquid, and it goes, and it's the best loan products are available on single family homes. So it's definitely not a bad asset to focus on. So I give you a lot of kudos for that.
Absolutely, absolutely.
You ever thought about going into another market?
I've got a lot of friends that do. They invest outside the market, but I've just made a business decision that unless I can drive by it myself and look at it within 30 minutes, then I'm not interested.
What was the first deal you bought?
I'm sorry?
What was the first deal that you bought? First
Wow,
house.
that's all the way back in 2003. So the first deal I did was on Mayberry Loop Road in Morehead City, North Carolina, and it was a bank-owned property. And now this was before I knew anything about private money. This is when I had a line of credit at the bank in 2003, and if you had a decent credit score and you could fog a mirror, you could get a line of credit. So I bought that house for $50,000, and I put $50,000 in it in rehab. So I had 100,000 in it, and the value was 140. So I put it on the market in the multiple listing service for 140, and it sat there for 45 days with no showings, and it was absolutely beautiful, staged, landscaped, the whole 9 yards. And so I read in one of those books I've been reading, put an ad in the paper and offer owner financing, and I did. And my phone rang off the hook, and I didn't even know what owner financing was, but I knew I'd figure it out. Well, Linwood was one of the first people that called me, and I showed it to him, and he offered me an $18,000 lease option deposit. There was only one problem with that. I didn't know what a lease option deposit was, but my daddy told me if somebody offers you money, take it and you'll figure it out. So Linwood wrote me that check for 18,000. Well, I was still a licensed loan originator at that time doing subprime loans. So I got Linwood a FHA mortgage, used that $18,000 towards closing costs and his down payment, and I cashed him out, sold it for 140, and I decided I like 40,000 better than 3,000 on a single wide mobile home.
That is a great story. I like that. I really like what you said about finding your private investors, your private lenders. I really like that dinner idea. I think it's very smart. I think it's very economical. Any other ideas? I know you said, local meetups. People sometimes have a hard time with networking, but it's such a powerful tool. Any other idea?
Yeah. Well, most people have got untapped over $1 million of potential private money just in their cell phone contacts. And so I have put together a 5-step simple system on how to attract that money without chasing it. The first step is make your list. Actually, in my book, which is called Where to Get the Money Now, I teach people how to make that list from your contacts. The second step is having a very, very simple opening conversation. And in the book, I teach what's called the direct method. The indirect method is very, very simple. The third step is what's called the 16-minute audio, stress-free investing. I have recorded that audio for hundreds of real estate investors across the nation, and that does the heavy lifting. You can just text that out. You can email it out to folks that you've got on your list. Step number 4 is where you put on your teacher hat and you actually teach the private lending opportunity. And my students use my PowerPoints and all that kind of stuff. Very, very simple. And then step 5 is getting a verbal pledge from the new lender. And then you go find a deal just as soon as possible to put their money to work. So that's the umbrella. That's the overall 5-step process to where you're not having to chase money.
Jay, this was great talking to you. And as part of the reason I do these podcasts is because I learn so much. I get to have a 30-minute conversation with somebody who may otherwise be either tough to talk to. And I'm not saying necessarily specifically you, but I get their full attention. It expands my personal network because now, hey, I have you in my email. I'm somebody and this allows me to, follow up with you offline and ask you questions and advice. And from the multiple people I've spoken to on this podcast, I've been in touch with many of them way after the recording is ended. And I definitely appreciate you coming on. And please, when I send you some follow-up emails, as long as I'm not badgering you, please respond. Jay, tell us about where we can get the book, how people could reach out to you, website, phone number, email, anything you want to share. Anything you say, they'll put also in the show notes, and they'll be, publicized as well.
Well, that's great. Thank you, Stephen. So the quickest way to connect with me is to take advantage of my free gift. So I have recently put together what's called the Private Money $1,000,000 Script Collection, and I can give your audience, Stephen, for free the very first script. It's called the Curiosity Opener Script. You can download that script for free immediately at jayconner, JAYCONNER. I'm an ER, not an OR. JAYCONNER.com/scripts. jayconner.com/scripts. You can download that PDF right there. Secondly, as I mentioned, my book's $20 on Amazon. Where to Get the Money Now. Don't give Amazon $20. Let me give you the book for free. Just covers shipping, and I'll rush it to you, express delivery. You can get my book at jayconner.com/book, jayconner.com/book. And then thirdly, Stephen, I've got a $3,000 gift for your audience, and that is 2 tickets to my upcoming Private Money Conference. It's a 3-day conference. I do it 3 times a year. And not only is it all about private money, but it's all about finding deals, negotiating deals. We do a rehab bus tour where we go out and look at the renovations on properties that we're actually doing. I teach how to automate this real estate investing business, how to sell any house in 3 days or less. So there's so much more to it than just private money. But all you got to do is a small registration fee, and you got a $3,000 gift for you and a guest. You can check that out, all the details, at www.theprivatemoneyconference.com, theprivatemoneyconference.com.
Jay, this was an incredible conversation. I think a lot of people listening are going to realize that access to capital is often more about relationships, communication, and confidence more than anything else. You took a setback that a lot of us had back in 08, 09, and even more, and turned it into a new business model, an educational platform, and you're helping a lot of other people. I'm happy to have you on. Thank you, Jay. For everyone, thank you for listening to this episode of the Wealth Clock podcast, available on YouTube for the full video, although most of my audience seems to listen on Apple, Google, some of the other platforms that I see in the stats, but that's always nice. We do put a lot of effort into the recording, but again, I think most people are really just listening. Jay, thank you so much for coming on. I really appreciate it.
Stephen, thank you so much for having me.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jayconner.com/moneyguide. That's jayconner.com/moneyguide. And download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jayconner.com/moneyguide to get your free guide. We'll see you next time on Raising Private Money